May inflation data came out last week and it was not pretty. We saw year-over-year inflation spike to 8.6% in May. It was 8.3% back in April. And unfortunately, this means that the end of this bout of inflation is not really in sight, and we're likely going to see inflation at least for the foreseeable future. So today, we're going to talk about this important topic in detail. We're going to talk about what inflation is, then we're going to dive into the numbers that were released last week and figure out what all that means. And then we're going to talk about how we even got here, what's likely to happen next, and how you can best protect yourself against future inflation. So you're going to want to stick around for this one because unfortunately, inflation is a really damaging economic force. And since it's likely to be with us for a while, you're going to want to learn how to best manage this situation for yourself. What's going on, everyone? I'm Dave Meyer, Vice President of Data and Analytics here at BiggerPockets, and I'm also the host of BiggerPockets' newest podcast called On the Market. In that show, every single week, we talk about the news, the trends, and the data that impact the economic climate and your financial decisions. So if you like this type of breaking news and information, check out On the Market's YouTube channel. There is a link in the description below. You should definitely subscribe because there's all sorts of great videos coming out from me, Jamil Damji, Kathy Fettke, Henry Washington, and James Daynard every single week to help you stay on top of your investing decisions. All right, with that out of the way, let's talk about what inflation is. And in its most basic sense, inflation means that the US dollar is becoming worth less. And that manifests itself in all sorts of ways, but the most common way you see this is by prices rising. So because the dollar is worth less, you need more dollars to buy the same amount of things. I'm sure you're used to seeing this. You're probably seeing this at the gas pump. You're seeing it at the grocery store. Pretty much across all sectors of consumer goods and services, things are getting more expensive, and that is largely driven by inflation. You can probably see why this is so damaging, but basically it means that things are more expensive and people have to stretch their budgets further and further to afford the same things that they used to be able to afford. And of course, this is going to negatively impact everyone, specifically and most dramatically, the people at the lower end of the economic spectrum, but it really can be damaging to the middle class and pretty much everyone in the economy as well. So that's why inflation is such an important topic for the government, for the Fed, for investors, pretty much for everyone. When we saw this data that came out last week that said that inflation spiked to 8.6%, that is really concerning because a lot of people, myself, pretty much everyone, was hoping that we were going to start to see inflation peak. We're not going to start seeing prices go down, but we were hoping to see at least the rate of growth start to decline. So rather than prices rising, 1% per month, last month in April, they only went up 0.3% per month. And maybe this month we were hoping to see 0.2% per month. But instead, it actually went up, and it went up to 1%. So I'm actually going to switch over to my iPad for a second. Can I actually show you the data? So here is the table that was just released by the BLS and shows the consumer price index data in detail for the last couple of months, as well as year-over-year data. So if you're curious or haven't looked at this in the past, there are, along the left side, all of these things over here are the different buckets of goods and services that are tracked in the consumer price index. And then, of course, we have different months here, and each number here shows how much it went up month over month. So if we look at this 0.3 number, as I was just talking about, that meant in April of 2022, all items, so the entire consumer price index went up 0.3% in April. And then in May, as I was saying, it actually went up 1% from April to May. So we saw the consumer price index for all items nearly triple its rate of growth from April to May. It went from 0.3% to 1%, which is a really significant difference. We also see here, just to show you guys how to read this chart, that year over year data went up 8.6%. So from May 2021 to May 2022, that's what we call year over year data, it went up 8.6%. And as a reminder, in April, it was at 8.3%. So this is the highest we've seen it in over 4 decades, and that's really significant. And as I was saying, a lot of people were happy with April's report because, as you can see, it showed a pretty big decline in the rate of growth. We were used to seeing for the last 6 months or so 0.7, 0.6, 0.6, 0.8. In March, we did see a 1.2% spike month over month, but that was largely driven by the invasion of Ukraine. And you can see that these energy numbers really drove that, right? So there was a lot of increase in energy costs in March. So we saw 1.2%, but then April came, we saw 0.3%. And that was pretty encouraging because it seemed like, although prices were still going up, the rate at which they were growing was starting to decline, which is what we need to see. In April, we actually saw a lot of encouraging things. So although energy is up in an enormous way, it was moderating in April, which is a good sign. We can't expect it to go down all at once. So if you see moderation or slight declines, that's really encouraging. You also see the price of vehicles going down a bit here. So that was all great. But now the data that came out last week for May and why it's so ugly is look at this entire column here. This is all positive. There is not a single negative number, which means that prices across every single category that is tracked in the Consumer Price Index went up last month. And that is obviously not the way we want things to go. If you look at this last column here, you can see the segments of the economy that are really driving inflation the most. And no surprise at all, it's energy is huge. So this line here, energy, this line here, energy, where it says 34.6%, that's all energy. So it actually, like, if you look at this energy, it makes up, this is like a roll up of all of this: energy, commodities, gas, fuel, oil. So all energy combined is 34.6%. But if you look at like fuel oil, for example, up 107% year over year. Gasoline, everyone knows this, up 50% year over year. These are huge, huge things that are impacting the economy in dramatic ways and are obviously going to continue given this most recent information. Of course, there are some things that are lower. For example, you see, let's see, what's 2.4% here? Medical care commodities, 2.4%. That's actually about the target for inflation. So that's not so bad. But everything else on this chart is way above what the Fed wants and what everyday Americans want, because no one wants to be paying more for inflation. So hopefully this analysis shows you why this data was so concerning. And in the future, hopefully this little tutorial will help you interpret the inflation data for yourself. But with that, let's get back to talking about how we even got into this situation and what's going to happen next. Okay, so hopefully that tutorial was helpful for you in understanding why the data that came out for May is so concerning. And in the future, hopefully that tutorial is going to help you understand how to interpret data better yourself. But with that, let's just talk about how we got into this situation. Earlier, I said that inflation is defined as a devaluation of the US dollar, and that is true. But the conditions that need to exist for that to happen is, I like to say, it is too much money chasing too few goods. Or if you want to put this into supply and demand terms, it means there is too much demand for too little supply. And if you know anything about the basics of economics, when demand is really high and supply is really low, that's when prices rise. And that is exactly what we're seeing right now. There's sort of this perfect storm for inflation because we've seen demand rise and supply decline. So how did we even get to that? One, demand is high for two reasons. First, I think is a hard thing to quantify, but after 2 years of people being locked down and not being able to live the lives that they want to live, they want to get back to normal. They're ready to go out and go to the movies, to go to restaurants, to travel again. There is really high demand for people to do leisure activities, to to do the things that they felt they couldn't do for 2 years. And the second is that the Fed injected trillions of dollars into the economy over the last couple of years, which means that people have more money. And so when they have more money and there is more monetary supply circulating around the economy, that means people are more willing to spend it. And so they have the desire to spend it and they have the money to spend it, which means that demand is super high. So like I said, it's too much money chasing too few goods. So that is the too much money side of inflation. Then, as everyone knows, we also have this situation where even now, even if the supply chain was normal, we have so much demand that we'd probably see outsized inflation. But we're also seeing a contraction of supply at the same time. I think everyone in the world knows right now that there are supply chain constraints, which are leading to fewer goods being created. Again, I said too much money chasing too few goods. Talked about too much money, and we all know there are too few goods. So that has created this perfect scenario, this perfect storm for inflation right now. And a lot of economists and people were expecting inflation to peak sometime this year and start to come down because of supply side improvements, right? Demand, I don't really know what's going to happen. They're not going to take trillions of dollars out of the economy. So I think demand might remain high, but we were hoping that supply side improvements would tame down inflation. And that made sense, right? Because you were thinking that after COVID, supply chain issues would start to come down, and that would at least help moderate inflation. But then there is this Russian invasion of Ukraine, and that has created a fresh set of disruptions in the global supply chain and is creating much more supply side constraints than we even had a few months ago. We're also seeing that in China, their policy against COVID, which is this zero COVID policy, they are locking down manufacturers, they are locking down shipping. And so we are seeing these two geopolitical events that are really outside of American control contribute to supply side constraints that are making inflation worse. And I think it's worth noting, obviously we're talking about the American economy and investors right here, but it is worth noting that inflation is really high and at multi-decade highs across the globe. So this isn't just an American phenomenon. This is happening in Europe, it's happening in Asia, it's happening in South America, it's happening everywhere. And US is one of the worst. The inflation rate is very high, but you see the Eurozone really high. In South America, it's crazy. So it is happening everywhere. So what is going to happen next? What can we do about this? Well, inflation can really only come down in two ways. Remember, it's too much money chasing too few goods. So we need either a reduction in demand or we need an increase in supply. Ideally, we get both. And so we reach this great equilibrium, but that's unlikely to happen. So let's see what actually might happen. As I said, just as we were sort of hoping that we would get a supply side improvements, that was ruined by the Russian invasion and all sorts of things. But I do think that over the next couple of months or the next couple of years, as the world adjusts to the post-COVID world, starts to adjust to the situation in Ukraine, we will see supply side improvements. It's not going to happen in the next month or in the next 2 months, but I do think over the course of 2022, we'll probably start to see supply side improvements. The only problem is that's probably not going to be enough, and it's probably not going to come fast enough to really make a dent on inflation in any meaningful way. So instead, what we need is a reduction in demand. And this is really what the Fed is trying to target. When they raise interest rates, what they're really trying to do is lower spending, right? So when they raise interest rates, it makes it more expensive for consumers to borrow. And if it's more expensive to take out a loan for big ticket items like a house or a car or student debt or whatever it is, that means people usually spend less money. And when they spend less money, that's just another word for less demand. And so, like we said, that could lower demand and help inflation. And this doesn't just impact consumers, it also impacts businesses, which is perhaps even more important because businesses, big businesses, when they want to expand into a new industry or a new geographic territory, or they want to grow faster, they often take out a loan to hire people or buy new equipment. And when higher interest rates are higher, they are less likely to do that. So that's going to slow down wage growth. It's probably going to slow down hiring. And as a result, that will bring down demand. So that is basically what the Fed is trying to do by continuously raising interest rates. So that's what the Fed is trying to do. They're trying to lower demand. And unfortunately, this doesn't just magically fix inflation and everything else is fine. When demand declines, especially in business spending, that means there can be layoffs, there could be a slowdown in the job market, and it's not like everything happens and it's all rosy again. There's going to be some economic pain associated with controlling inflation. And unfortunately, it also takes time. Right now, there are 11 million job openings in the United States right now. And so the impact of rising interest rates, businesses either laying people off or slowing down their hiring, is going to take months to ripple through the economy. So that's why I think inflation is going to be here for at least the next couple of months. Secondly, this just means unemployment is going to rise. So like I just said, it's not going to be an easy ride. There is going to be some economic pain. And unfortunately, the economic pain is often centered around those at the lower end of the socioeconomic spectrum. But ultimately, I do believe this is needed. It's painful and it sucks and it's going to be really terrible for a lot of people. But inflation itself is a really damaging force. It deteriorates people's savings. It reduces their spending power. And it can be actually really destabilizing for democracies and society in general as people lose faith in the currency that sort of binds the entire economy together. So it really needs to come down. But I believe, and this is just my personal opinion, that it is going to take a while to come down. And in the meantime, the economic picture is going to remain relatively cloudy. As interest rates do rise, I think a recession, unfortunately, is probably likely. But keep in mind that recessions do come in all shapes and sizes. Of course, the last big recession back in 2007, 2008 is on top of everyone's mind, but that was the biggest recession since the Great Depression. And so not every recession looks like that. And hopefully the recession that I personally, and this is just my opinion, believe is coming in the next year or so, it could be sooner, is not going to be as bad as what we saw in 2007 because it's unlikely, and really recessions are rarely as bad as they were in 2007. But at this point, it's really just too hard to tell. But just keep in mind that it's not necessarily going to be that bad, and probability-wise, it probably won't be that bad. So what can you actually do about this? We have inflation. It's likely here for at least the remainder of this year, and it could be even longer than that. There is a recession pending. What is my best advice? Unfortunately, there aren't too many good options, but there are investments that can help you hedge against inflation. People also point to gold as a good store of value, but personally, and I am biased, I prefer rental property investing because it offers several ways of hedging against inflation. First, it's sort of dynamic, right? As inflation goes up and the dollar devalues, home prices often keep pace with inflation. So you're not losing money by having your money invested into an asset like housing. Secondly, rental income is dynamic as well. So as prices readjust and the cost of things changes, you can change your rent at the same time to keep pace with inflation so that you're not losing money relative to inflation and you're at least keeping pace. And then lastly, you also get benefits of real estate investing regardless of the economic climate, like tax benefits and the amortization, otherwise known as loan pay down on your investment. So for those four reasons, I find that rental property investing is the single best hedge against inflation. And again, I am biased, but you can Google this. A lot of experts who aren't necessarily real estate investors believe this as well. This is a long-held belief that rental property investing is a great inflation hedge. So I personally recommend looking into it if you're not already doing it, or if you're like me and are an existing real estate investor, thinking about buying more property to help you hedge against inflation. All right, that is all the information I have for you today. Would love to hear about how you feel about inflation or what you're doing about inflation to hedge against it in the comments below. Or if you haven't want to interact with me at all, the best way to do that is on Instagram, where I am at The Data Deli. Thank you guys so much for watching. If you want more information like this, don't forget to check out the On the Market podcast or YouTube channel. Thanks so much, and I'll see you all again soon.